He told me I can't compare the 2008 crash to 2022 because there's just too many differences. He suggested I look at the 1990 crash. Hey, Kevin Amos, Pine Financial Group, where we work together so you succeed. Hey, you found us here on Facebook, you found us here on YouTube. Please help us build a community. Hit like, hit subscribe. We want to help more real estate investors just like you. Are you ready for the 2022 housing crash? Hey, I did a video and an article about the 2008 credit crash, the crisis, the housing collapse, and how it compares to 2022. And I gave 6 reasons why I would not compare the two and why I believe we might be headed more towards a soft landing and why I wouldn't expect the crazy decline in property values we saw in 2008. And I'm always asking for feedback. And you know what? I got it. I got a lot of love mail and I got some hate mail. And there was one individual, we were going back and forth via email for a little while. And I actually got a lot of respect for him because he gave me some insights that I wasn't quite thinking about. He told me I can't compare the 2008 crash to 2022 because there's just too many differences. He suggested I look at the 1990 crash. That way I can learn more about what is happening now and hopefully make better investment decisions. So I want to compare the two for you so to help you make better investment decisions as well. So 1990, there was a housing crash. It was about several years long, but in the first year is where it really hit. There was about a 7% decline in median home prices in the first year, and then over the next several years, approximately another 7%. So 14% decline in total, and then it started going up. Now, what's interesting is that 1990 and 2008 are the only 2 crashes that had any significant impact to housing in the last 9 recessions. That's as far back as I looked back. So just because we are entering a recession now doesn't necessarily mean it's going to impact housing. In fact, the last couple, we saw prices increase in housing and significantly as well. COVID is a great example of that. So I do have some notes here. I'm going to read through this just so that I can help you get a good understanding of 1990. And then I'm going to go through what I'm concerned about and what I'm not concerned about as far as 2022. Now, I took this comment and this dialogue with this individual very seriously, and so I wanted to address 1990 as he suggested, and I did so in a 13-page report that I want to give you absolutely free, and it's going to give you all the details, all the graphs, all the information that I was able to learn and study to come up with this comparison. So go get that report now, absolutely free. So the 1990 crash all started with the S&L crisis, savings and loan crisis. So I'm going to go through this rather quickly because this is a big impact. So I want to give you as much information quickly as possible. So it all started with rising interest rates and inflation. So back in the 70s and even 60s, we saw tremendous government spending. And how do you pay back government spending? Inflation. That's how we pay back when the government spends out of control. So we saw inflation increasing and increasing and increasing, and the government finally started to fight back, and they do that by rising interest rates. Interest rates going up, 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 until it hit its peak in 1982 at over 18% on a home loan. A home mortgage was over 18% in 1982, and that was a fight back inflation. Well, here's how that impacted the S&L industry. So savings and loans bring money in from the community and they loan it out, and they were restricted in 2 ways. One, they had to make home loans, so they couldn't do any creative type of financing to increase rates of return. They were stuck in home mortgages. And 2, they had interest rate caps they could pay their depositors. So they couldn't pay too much or increase the rates over a certain amount for depositors. Well, with 18% mortgage rates, you saw a lot of investors starting to save money, and they're putting them into banks and other investments with fixed rates of return, and they're pulling money out of the savings and loan industry because they were capped at how much they could make. Why would I invest in a savings and loan when I can go over here and make twice as much money? So we saw the liquidity in the savings and loan industry fall apart. We saw all their assets in fixed rate loans, fixed rate income. So their income was fixed here, the rates that they were paying here, and it's just a recipe for disaster. So they started going out of business. So the government stepped in with deregulation to try to even the playing field. No more restriction on interest rate caps. They could pay their depositors anything they wanted. no more restrictions on the type of loans they could do. In fact, the deregulation was such a big swing that we started seeing some crazy lending. Does this sound familiar? 2008. So we saw adjustable rate loans. This is kind of when those started happening. We saw lots of commercial creative lending, sometimes 100%, many times 100% financing. We saw equity participations from the S&L industry. So they're investing in projects hoping to pay in or cash in on the upside. So it's very risky compared to staying on the debt side. So all of this was going on, and commercial banks weren't able to do that because their regulation never changed. So all of a sudden now we're back to a non-even playing field, just like we had before, just the opposite. Now it was unfair in the S&L's favor. So S&L's industry was going crazy. We saw home prices going crazy because of all these loans coming out, commercial real estate values going crazy. So we saw this big spike in all of that, but we saw home prices starting to come down. So we saw the S&L industry starting to really hurt, and there was not enough insurance to insure all these depositors. So what were you going to do? What could the government do? They couldn't pay back all the depositors, even though they promised them that they would. So they ended up having more regulation around the S&L industry, and out of that came the RTC. The Resolution Trust Corporation is the entity that was responsible for liquidating S&Ls, liquidating their assets. So they ended up dumping properties at fire sale prices, driving home values down. If you were an investor in this time, you probably got some fantastic deals. Hopefully you still own those properties. So the RTC, big entity that impacted the housing prices, and that all came out of the S&L crisis. So we talked about the run up in values. We talked about the S&L crisis. With the S&Ls pretty much wiped off the map, they were originating over 50% of the loans. You take 50% of the loans off the table, or the entities providing those loans, you're going to see an impact in housing. And we had an oversupply in housing because of all the new construction loans. Oil prices collapsed twice, once in 1985 with Saudi Arabia deciding to increase production, then again in 1990 in the summer when the Gulf War started. And so that had a big impact on the S&L industry because of loss of jobs, and they were heavily invested in oil and oil production companies. And then finally, stagflation. The gentleman that we had a dialogue with told me, look at stagflation. So stagflation is a slow growth economy with high unemployment and high inflation. Very unusual, and it's very hard to combat that. You combat inflation, for example, with rising interest rates. If you raise interest rates, it hurts the job market. So you have two problems, and the fix for one creates a bigger problem for the other. So that could create a tailspin for an economy. So let's compare it today. Here's what I'm concerned about. I want to talk about what I'm concerned about and what I'm not concerned about. First, the high inflation. Obviously, this is the biggest concern. Inflation is out of control because of all the government spending during COVID. So it's exactly like we saw in 1990. The way you combat that is rising interest rates. So my second concern is the pace in which the government is increasing rates. It does resemble 1990 housing crash. We're seeing rates increase every single month pretty much, and there are big jumps, 75 basis points. Those are the types of things that could put an economy into a tailspin. And then finally, inventory. Anytime you see inventory increase, you have a recession. All the graphs again for this, it's pretty cool to see these graphs. So go get that report so you can see these graphs. Back then, inventory levels were 9.5 months of inventory. Months of inventory just means if you stop adding inventory to the market, how long would it take you to get through all of it, sell it all? It's a good way to look at supply and demand. So 9.5 months of inventory back in the crash in 1990. Today, we're seeing 10.5 months of inventory if you look on a national scale. So that is definitely a concern. What gives me some comfort there is real estate is such a local asset. And in the markets that we work, for example, Denver is at 1.6 months, Minneapolis is at 1.3. I would look very specifically at your market and the months of inventory. If you get over 5, it could start to become a concern. 5-ish, 4 to 5 months is a very stable, balanced market. So 10.5, what we're seeing today, obviously that's a concern. What I'm not concerned about, look, we don't have those oil price crashes. We don't have a Gulf War going on. We don't have Saudi Arabia just pounding us with more and more supply of oil. In fact, it's the opposite. We're having trouble keeping up. We're starting to use our reserves to help other countries over in Europe. So we don't have the big oil crashes that we had back then. Interest rates, yes, they are going up significantly, and that is a concern. But what gives me some comfort is you'd have to triple the interest rate to hit what we were seeing back in the early 80s that led up to the crash. 18% interest rates on home loans in 1982. We're not quite there. Jobs. We have a strong job market, 3.7% unemployment rate, which is pretty low. If you're at 5% unemployment, they say that's a full capacity. So you kind of want to be at or below 5%. Leading up to the crash, it hit 8.4% unemployment. So we have some room there. Obviously, the war, the Gulf War, we don't have a Gulf War now. We don't have any war, but I get a little nervous saying that because of what's going on in Ukraine. We don't think we're going to be getting sucked into that one, and as of now, we're not. So as of now, it's not a concern. We're not fighting a war. And then again, the S&L crisis and the RTC, big impact, pretty much, in my opinion, created that crash, and we're not seeing any of that. In fact, all the regulation from 2008 is still in place today. So we're seeing strong, sound underwriting. We have record credit scores. We have record low loan to value ratios. All of that is helping insulate us from a big crash like we saw in either 90 or in 2008. So I don't think we're going to see a big crash like we saw in either of those. If you want to know my opinion on, much more detail on this and what I'm doing with my own personal investments, download that report. Again, it's absolutely free, comparing the 90s recession to what's coming in 2022, what I think is going to happen. Obviously, I don't have a crystal ball, but anything we could learn from the past. It was Mark Twain that said, history doesn't repeat itself, but it does rhyme. So we could try to learn something to make good investment decisions going forward. Get that report. You could get it at pinefinancialgroup.com.